How you guys doing? This is going to be a short one because I don't want to get too philosophical and detract from the point. The entire retirement industry of the United States is contingent upon capital gains. And you say, well, what is a capital gain? Because it sounds like important, okay, well, I understand that, but it's very important for everybody, so let's talk about it. A capital gain is where you buy an asset. It could be property. It could be a stock, it could be a bond, it could be a mutual fund, it could be anything. And let's say you pay $10 per share for that stock, or you pay $100,000 for that property. And then when you sell it later, it goes up in value. You sell the property for $200,000, or you sell the stock for $20. So you have a $10 capital gain on the stock, and you have a $100,000 capital gain on the asset. And you say, oh, isn't that nice? Isn't that wonderful? And yes, it is nice and wonderful, but that assumes values always go up in real terms adjusted for inflation, which is another key thing which we're not going to talk about. But regardless, the whole point is that the entire retirement industry is contingent upon capital gains. I'm going to invest in my 401k, I'm going to invest in my IRA, and then the stock value, the mutual funds will go up in value, and I sell it for more than what I invested. But you got to ask yourself, doesn't it seem kind of like really too good to be true? I mean, doesn't that seem, why invest here and it just magically goes up? Like, what did you do to make the stock price go up? Did you work harder to make the stock price go? No, I just took $10, threw it in. Now it's 20. And you got to really think about that. Say, well, wait a minute, why is it just so simple like that? You just throw money into a stock and it just goes up? Well, shit, I'd borrow money and invest it and it just goes up. And this is where the issue of dividends and earnings come in. And this is something that has been completely not dissected, but completely chopped off and completely removed from the reality of the stock market or mutual fund market or whatever you want to call it. Stocks, mutual funds, bonds, whatever investment you want to call it, only has value because it generates profit. It generates earnings and income. Like if you say, oh, I'm going to start a company. Well, why would you start a company? Why would you take your money and invest it into a company? What, for shits and giggles? For sitting there and, playing video games? No, you invest money, you start a business so you can make more money than what you put into it. So the earnings or the profits, or what we call dividends or interest income or income, there's many different names for it, that's got to validate the amount of money you invest in. Now, many people invest money and they lose money. On top of restaurants, a perfect example, bars, they'll spend $250,000 and they'll still lose money. Usually because they're chasing a dream because they're dumber than shit. Just watch Gordon Ramsay's Kitchen Nightmares or Hotel Hell or Bar Rescue or anything like that. But even if you make a profit, you spend $100,000, let's say you made $10 profit. Was that worth it? Was it worth it making $10, which is what, 0.0001% rate of return? So it's the same thing when it comes to stocks or mutual funds or property, any kind of investment for your retirement. Everyone looks at retirement like I invest for 10, I get 20 down the road. Well, what drives it to 20? Well, obviously it has to be the profits. So not only do your prices go up, but to make that legitimate, to make that sane, to make it validated, your earnings and your profits or your interest or whatever profits, money is being derived from that investment has to go up as well. Now, the problem we have here in the United States, and in many other countries as well, is that, I don't know why, but the government just decided, like, hey, if you invest in 401ks and IRAs, we're going to give you a tax deduction. We're like, okay, government, we'll do that, okay, HR lady, we'll do that. And you just throw trillions of dollars into the stock market with no freaking regard as to whether or not the money you make off of that investment rationalizes it and validates it, makes it worth your while. People just throw the money in thinking it's like, well, it's X now, but it's going to be Y later. And then I sell on the capital gains. But I'm here to tell you, there's no such thing as capital gains. Capital gains is a psychological myth. I know it's real. I know it happens. Obviously, prices have been going up. I'm not disputing that. But what I'm saying is that you have to consider whether or not throwing trillions of dollars into an economy, into a stock market, has an inflationary effect on the prices you're paying and whether or not the money you're getting in return is worth it. Now I'll be blunt and direct. It isn't. It isn't. There are two measures that we can use to measure whether or not the investment in a stock or a mutual fund or whatever other investment is worthwhile. One is the PE ratio. That's where we have price divided by earnings. You take the price per share of a stock divided by the earnings per share of a stock, and you say, okay, what's the ratio? Now, we do this every day when we buy stuff. Let's say you buy a Big Mac. Are you willing to pay $50 for a Big Mac? No, because the price to the earnings would be the consumption value. Like, oh, I like Big Macs, and it would, acquiesce my hunger or whatever. You'd say, well, I'm not going to pay more than $4 for a Big Mac. I'm not that hungry. Would you pay $40 a gallon for oil or a gas rather? I said, no, I wouldn't. I'd just stay at home. Sergeant Rumpy Fluffalo. I know the girls like Sergeant Rumpy Fluffalo, and he's quite the ladies' man. But would you pay more than $100 for this? I think I paid $8 for Rumpy. The question is, what do you pay versus what you get? Now I got a cute little buffalo, and girls, well, actually, Rumpy has helped me with the ladies in more than one occasion. Oh my God, he's so cute. Point is, price versus value. Now, if you look at stock prices or the stock market, nobody cares. It's like amazing. Everyone gets pissed off if gas goes above $3 a gallon. But then when it comes to stock prices, no one looks at PE ratios. Everyone, just invest. Okay, HR lady, I invest money. And you're paying a PE of 19. Some measures are more like 26. Depends on what statistics you want to use. You're effectively paying twice the price that it has historically been. You're almost paying $10 for a Big Mac or $8 a gallon for gas. But no one thinks about it because they just invest it. Now the second measure is a dividend yield. You say, well, what's a dividend yield? Well, who cares about earnings? Everyone looks at price versus earnings. What earnings per share are, what the company earned in profits. You buy a share of a company and you got one stock. That stock entitles you to the earnings or your proportional representation of earnings in that company. Well, actually, you don't even get the earnings. You only get dividends. Dividends is the only thing that matters. Dividends is the only thing that's paid out. So the dividend yield, what you pay in stock price versus what you get in dividends per share as a percentage of the stock prices you're currently paying, is below 2%. That's less than inflation. And again, this boils down to two major things. One, all the retirement dollars driving up prices that the dividends that are being paid out are not even keeping up with inflation. And then also quantitative easing, where the federal government, through different machinations, the money inevitably ends up in the bank's balance sheets, and they say, well, we got nothing else. Well, let's just invest in marketable securities. Or corporations borrow money because of low interest rates, and they buy back their shares, which further drives up the stock price. In other words, regardless of what measure we use and whatever's happening behind the scenes, the price you're paying for 1.8% dividends, it's not worth it. It's just not worth it. So what America has to do, and what everyone has to do, is start accepting the fact that there is no such thing as capital gains. I know there is, but if you're looking long-term investment, if you're looking for value investment, you got to stop looking at the stock market as this magical vehicle that just magically goes up all the time. And it will. Don't get me wrong. It probably will because of inflation, because the government keeps printing off more money, and that money inevitably ends up in the stock market. Everyone flows the money with their 401ks. I know there's a new normal. I understand that. I'm talking more from a philosophical, economic, literal sense. Is it worth it? I mean, really think about this. This is why I had a great question on one of my classes. If you want, go to one of my, I have two classes. One's called The Analysis and Valuation of Stocks. The other one is Stocks, Bonds, Investing. They had a great question. They said, what are you investing in? I'm like, I'm not investing in the stock market. What am I going to get, 1.8%? I don't think capital gains. I think, what am I getting cash flow? What am I getting cash flow? And if you look at it in more of a realistic, literal sense, you start to realize, 1.8%, that doesn't even beat on inflation. I got other shit I can invest in that will provide a much higher rate of return, much higher. And so we're looking at things like paying off your debts. What's your mortgage? Is your mortgage for, my buddy, a friend of mine, he's like, well, I got a lot of money left. He's been very successful, well, not lucky. He worked for it, a very hardworking man. I don't want to besmirch him. Anyway, the guy's got money. He says, what should I invest in? I said, well, you got any debts? He's like, yeah. I said, what's your mark? Yeah, it's 4.25. I'm like, pay that off. Where are you going to get 4.25 solid rate of return? No risk. Paying off debts, there's no risk in that. No one's ever gone bankrupt paying off debts. Doesn't happen. It's antithesis of paying off debts. So he paid it off. He got 4.25% rate of return on his money, risk-free, I might add. What else can your personal ventures. A lot of people, this is why I invest in my own let's say I got an extra $2,000. I'm not going to invest in the stock market. Frankly, no. I don't care what am I going to get a tax deduction on $2,000 off my pithy amount of income that I have? I'm not rich. I don't make a lot of money, so it ain't like I get a huge tax deduction. I'd rather take that money and start some kind of business venture online that's going to have a higher rate of return. And so this kind of gets back to the original concept of humanity, or economic humanity, or human economics, if you want to call it that. There was no stock market 401k IRA bullshit 100 years ago. You invested in the farm. You invested in real things. You invested, you do know, like when you, quote, invest in the stock market, there is no investment. You are buying stocks and bonds from one group of people that had already bought it from another group of people that bought from another group of people. That money does not go and invest anywhere. It doesn't create factories. It doesn't create work lines. It doesn't create plants. It's you're just trading baseball cards at this time. The original investment is that the IPO, when the company originally sells the shares, they raise the money, they take that money, and then that company invests it. What happens to the stock after that there's no investment. There's not an investment. This is why everyone thinks, oh, look, the stock market's up, Barack Obama's great. No, the stock market has nothing to do with the economy. The stock market can get all bubbly as all at once. It has nothing to do with the economy. So you're not investing. And that's what Americans have to get back. Well, not just America, everybody has to get back to is, what is my rate of return? Do I get a good return, an adequate return for the money I invested? And right now, you fucking sheeple, you're out there, you're just blowing away trillions of dollars on 401ks, IRAs, all this other stuff. For what? 1.8% rate of return? I know the capital gain. It might go up. I know, we already talked about that. But, there's no investment. So reconsider your retirement plans. I'm not saying don't invest in a 401k or an IRA, because that actually is quite a good inflationary hedge. But think about what is the rate of return you're getting on your investment. Don't look at capital gains. What kind of dividends do I get? What's the earnings of the company? What's the earnings of the mutual fund? What's the earnings of the ETF? What's the dividends of the ETF? If it doesn't beat inflation, dude, you probably have other much better uses of that money than investing in an overinflated market. So, anyway, just want to let you know, capital gains don't exist. There's no such thing as capital gains, even though they do exist. And if you want to check out any of my other shit in economic world, actually, go take my classes. That would be much more thorough than what I'm trying to explain here. Stocks, bonds, investing, oh my. The analysis and valuation of stocks. 2 classes that I teach. Search them. Well, how do I find them? Google them. Just Google them. You'll find them. And they're offered different schools and all that other stuff. But also check out my website, captaincapitalism.blogspot.com. Go to my you're actually at my YouTube channel. My podcast, that's what I meant to say. Search for the Clary Podcast, where you can get more rant, raving, and super awesome economic genius like this. Toodles.